Good morning, ladies and gentlemen. My name is Adam Davis, and welcome to episode 127 of the 11FS FinTech Insider Breakfast Show. In this show, we bring you the best and the brightest from around the fintech and banking landscape every single weekday, straight to your homes here live on LinkedIn. Today, we're joined by Ammar Akhtar, CEO and co-founder of Yobota, and we're going to be talking about innovation and personalization in financial products. Ammar, how are you doing?
Yeah, really good, Adam. Thanks for having me on the show.
It is a pleasure, a pleasure. It feels like it's been a long time in the making, but it's great to have you on. Listen, as ever, if you've got any questions, if you've got any comments, leave them in the sidebar on LinkedIn, and we'll answer them live for you on the show as we go. Ammar, let's start off a little bit about your background, and then a little bit about Yobota. So, I guess, how did you get into it, and how did you start this off?
Yeah, sure. So before Yobota's been going for about 4.5 years. Before that, I was in consulting, worked at Accenture and at a company called Capco, and we essentially did projects for large banks, small banks, and I was involved in the wholesale side and the retail side. So I had about 10 years of just kind of getting a really good oversight of lots of parts of the industry. My time in consulting came to an end. 10 years was enough for me, and kind of after I left, I essentially kind of had two things going on in my head. One was that I really wanted to build something that was going to last. Like, consulting doesn't always give you the chance to do that, particularly traditional consulting. And I got introduced to a group of people who were looking to build a bank, which I'll talk about in a bit, but wanted to go asset-led and technology-led, which at the time, if you think back to sort of 4 years ago, and what was going on, there were a lot of companies coming up which were going very much deposits-led, prepaid card-led, and there's been some fantastic success stories out of that. But these guys had a separate hypothesis, and we had a conversation which basically went along the lines of, if we wanted to go technology-led rather than buy a large sort of loan servicing kind of package off the shelf and then start hooking things into it, we think it'll be cheaper, and we think it'll actually give us a lot more flexibility going forwards in terms of where we want to take the business. That was sort of the backing of the conversation, and that very quickly became well, why don't we just build the tech and the technology company, and then the bank licenses it, and we have a sort of separate vehicle with which we can actually solve some of the core challenges around financial products. And that's really how Yobota started. And Yobota is a core banking technology vendor, which has, over the last 4.5 years, sorry, I've got a frog in my throat, 4.5 years, we built our own system that runs in the cloud. It allows clients of ours, could be banks or lenders, to set up financial products that they want to take to market, get them distributed through online channels. We enable the onboarding of customers and facilitate calls out to ID bureaus, credit check companies or credit check systems, fraud checks, all that good stuff you have to do when you're onboarding yourself for a financial account. And we do the actual sort of interest rate pricing, fee pricing, and so forth as well, and then lifecycle accounts, service the accounts as they go. So it's quite a big system, but it's been a number of years in the making.
Yeah, I mean, it is amazing. Like, if you look back to your point, sort of 5 years ago, you're looking at some of the, I suppose, the neobanks, how they were built, as you said, predominantly on prepay, predominantly through partnerships. And I guess the banking systems that sit underneath that, whether it be sort of modular core banking system, or whether it be like a BaaS system, if you like, and whether you serve banks or whether you serve like non-FS brands, the evolution over, like, I guess, the last 4 or 5 years has just been like monumental compared to potentially like the 10, 15 years prior to that. I guess, from your perspective, where do you see the differences? And we'll go sort of in a macro level, but where do you see the differences between, I suppose, offerings and services like you can provide, and potentially like some of the old guard? And I'm not going to name check too many, but you kind of know, let's say the big US institutions that power, a lot of the community banks and those kind of guys. Where do you see typically the big differences between the stacks?
Yeah, sure. I mean, I think it's important when, like, not to sort of disparage what those guys have done and what the service that they do provide, because this is a really complex space. And actually, it's a bigger space than most people realize, because as you mentioned community banks there, but there's also kind of credit unions, there's small business banks, there's specialist lenders, there's general purpose lenders and deposit institutions and savings banks and all that sort of stuff. It's a really, really big space, and every sort of customer segment has its own needs, and then there's geographic variances and so forth. And a lot of these guys have, over many years, and at the cost of many tens of millions, hundreds of millions of dollars, actually solved those problems, arguably really, really well for the point in time when they developed their products. I think where we and a number of other kind of new generation core banking technology platforms coming from is that there's been a complete sea change in how the underlying tech and the underlying infrastructure of this stuff works, right? Like the whole sort of shift towards cloud, the shift towards smaller kind of microservice-based, container-based architectures, and so forth. So a lot of what we're doing is centered around that, to say, well, how do you actually architect the system a lot better so you can really, really bring the cost and the cost down and the efficiency up, and by doing that, you can then get into a position where it's actually a lot less risky, and therefore more possible, in theory, more possible. And there's clearly a lot of risk appetite of the actual regulated entity that faces the end customer, the end consumer. It becomes a lot more possible to then start offering kind of the next generation of products and the next generation of sort of actual financial services, right? And a lot of them will look very similar to what we've seen before, but then we're also going to see changes to like embedded finance and stuff like that.
Yes.
That people in this show have spoken about as well in the past.
Yeah, I was going to ask you about that, because it's quite interesting. The one of the things that we see a lot, so embedded finance, the buy now pay later is a classic example of that. But the embedded finance, how it's manifested itself really over the last, let's say again, 3-4 years, is a product of the systems that it can play off, if you like. It wasn't possible to do this kind of services, prior to, let's say, a fair few years ago. You yourself, I wanted to talk. I'm going on to start to talk about your client base, but in terms of those who use your platform, and Fronted is a good example, and they're obviously friends of the show. They're hitting a specific niche, which is awesome. But from your perspective, is that really only possible now because of the platforms that you guys and you yourself are providing? As in, would you have been able to do that, let's say, 10 years ago? And therefore, are we going to see more and more, I guess, specialized finance products come out as the cost to serve those niches, I guess, gets lower?
Sure. I mean, I think it's kind of important to not forget that you could buy sort of sofas or things like that, or laptops of like a PC World website, and sort of get click to buy finance previously. And there were companies that did this, but like and we've spoken to a couple of them in the course of what we've been doing. But what you end up with is like this real sort of Frankenstein kind of situation going on behind the scenes. So yeah, as an end customer, you're sort of getting a click to buy and buying my sofa, but it's not the sofa company, it's someone else who I'm actually dealing with for the finance. And if that goes wrong, I'm dealing with someone else behind the scenes. And that sort of finance supply chain is probably not going to change, but you're going to see like the actual the sort of who you're facing off to as a customer. I think that will change more and more, and that'll become a bit flatter. So you'd have kind of fewer companies to keep in your head, basically, as to who am I dealing with now because something happened. And I think that is one of the bigger changes we're starting to see now, simply because the barriers to entry are lower, right? So, like with what we've done with Fronted and with what actually lots of other companies are doing with other vendors and some conversations we've got going on as well, which might bring more things to market in the coming months. You essentially can set yourself up faster. You can set yourself up in a much more cost-effective way, and you can set yourself up with just the services that you need. Right? So you don't have to buy the whole package of of whatever your loan servicing system, your saving system was that you're sort of pulling out of the shelf from some existing vendor. You can talk about like the 3 APIs that you need, and that's it. You don't have
Yes.
to necessarily worry about the fact that because you're using a particular package vendor, you have to use a particular payments provider. You have to then push all of your, your core customer records down into that system as well. You can be, you can be very, very selective about how you're using those, vendors. And I think that is actually something that's going to become an enabler, because you give that sort of flexibility of operating model, and that's flexibility around the choices that people have for the overall business that they're trying to set up.
Yeah, and I think that's a really good point, because and Dan Feeney, morning Dan, has just sent in a question, and it was actually the next one I was going to ask anyway. But is so right on time? But that flexibility, for me, is one of the main things that maybe differentiates, let's say, a new I guess startup player versus one of the incumbents, just because of the you're not tied into the legacy partnerships, and you can actually, the speed of choice or of introducing choice, I guess, is a lot quicker. And Dan asks, are the legacy core vendors like Temenos and Finastra, I've just name checked them, I'm sorry, are they keeping up with the digital first native ones like yourself? So, and I guess without again going into specifics, but are you guys like looking at it and thinking, we're on a pretty good run here, but actually in 5 years' time, those big behemoths are going to catch us up? Or actually, are you like, well, we're kind of so stealth that we can operate in the same world and still, have a good slice of the pie?
Yeah, I mean, that's it. It's kind of as ever with me, right? There's like many layers to that, and there's one thing to sort of kind of bear in mind, which is the industry is really, really big, right? So it's not like everyone is going to be looking at. Well, I don't think it's possible for one vendor or one collection of vendors to serve the whole industry sort of at at scale at sort of an equivalent service level. So I think there's opportunities for everyone everyone is in the sector as a result. There's kind of also a case around the fact that basically as as time moves on, actually there are so many new disruptive services coming on, particularly in payments, right? And like increasingly so in sort of the sort of credit decisioning space and so forth. Large vendors aren't necessarily going to be interested, and particularly established vendors aren't necessarily going to be interested in some of the newer providers until they see a large enough demand and large enough volume. Whereas where platforms like ours and others who have more of a sort of plug and play kind of architecture, or more built on more philosophy of kind of open integration, you can kind of just very easily start hooking things up as and when you need, and you don't necessarily have to maintain the more expensive, and I'm talking about technically expensive sort of integrations into all the providers that are sort of that have been around for a longer time. People have been using more and more. There's a natural shift that's going to happen, and again, I'm talking particularly in payments, because that's actually one of the areas where we see lots and lots of change and lots of new providers coming in. So
cool. Okay.
I'm not sure if that answers Dan's question fully, but it's
it's good. Hey, listen, yeah, I mean, I think there's it's inevitability that they're going to be looking and sniffing. But I think to your point, it's that kind of it's the barrier to entry of serving a niche which is potentially too low for them, but also very big for others. So it's like, how can they incorporate that kind of functionality into their behemoth processes quicker than you guys could? And is there the market for them to do that? So
and actually, is there a demand? Like, is there an appetite for if you are the size of like someone like Temenos, as you said, like, you're not necessarily going to be interested in smaller entrant players, or you're going to be very, very selective about those. Or you're not even necessarily going to be scanning for those sorts of opportunities, right? But equally, like we're in a couple of processes with some reasonably big names as well, despite being a lesser known provider. And I think the merits of the product, and the merits of the platform, and the merits of the credibility that that's been built around whatever the platform is, are actually in very valuable currency in these sorts of these sorts of conversations as well. That you're not just trading purely on brand value, you're trading like existing in a historic brand value. You're sort of trading on the fact that we know what we're doing, we know what it takes to run a bank, we know how to get you set up, we know that actually you need these 3 ecosystem partners to hook into, and we're done because the rest of it just works in what we've built.
Let's well, I'll build on that, because we'll talk a little bit about your platform. So I suppose in order to supply, I guess, again, some of these sort of more nouveau use cases, for want of a better word, can you give us, I guess, some of the examples of what your platform can do? And I'm specifically interested, I guess, in the personalized products that I suppose front end providers are building off the back of the capability that you're supplying. So like, what are, amongst your tenants, if you like, I'm not sure if you call them tenants, but what's the most interesting use cases that you've got, that you've seen and you've thought like, that's pretty cool, like from a front end perspective, that's again using what you've built in the back?
Yeah, sure. So, I mean, the one that's we talked about previously, and that's kind of out there right now, the reward loan, the so Chetwood's our client. That's the bank I was sort of talking about at the top of the show.
Yep.
There are first client. They have a number of brands, across lending and savings. So LiveLend was their first lending brand, and the LiveLend product, or the sort of the differentiating product around LiveLend. There's many great things about LiveLend, but the differentiating product around LiveLend is what they call the reward loan. It's a kind of a really simple concept of, as you normally you take out a loan, you have you get an interest rate, and you're sort of holding the debt for like 4 years, and you're paying it off and whatever, but like nothing changes on that account. But actually, you as a prospect, you as an individual, you as a borrower, your circumstances do change. So the reward loan essentially seeks to address that. As your credit score goes up, your APR goes down. Mm-hmm. Really simple concept. The APIs that we provide essentially allow that to be executed through essentially data ingest of bureau information around credit scores and changes to those over time for individual borrowers. That essentially then translates into hopefully a decreasing rate over the life of the loan for individuals. And that was a certainly in this country, that's not something that has been done before in the consumer lending space. And that's a very, very simple thing. It's not it's not kind of at the bleeding edge of what's possible, but like we've spoken about patterns around things like auto finance, where actually you essentially have some sort of telemetry that's coming out of the car that's going straight into some database sitting behind the platform, and based on mileage, engine usage, being inbounds, out of bounds, or whatever, you can start triggering fees or charges, or or even reductions to the cost of running a car, because increasingly car finance is essentially moving into a lease model as well. So things like that become quite are extremely possible, right? And that's what we're speaking to certain clients about. Also, just kind of we have a very, in general terms, we have a very powerful sort of core interest rates engine that actually allows us to do a lot of reshaping of accounts, individual accounts or groups of accounts, just based on just kind of on demand, and those things can get triggered by various data feeds and the sorts of examples I was giving. And that's kind of what it comes down to, right? Like, which is that I, as an account holder, have some change in circumstance that's either baked into the contract that I've got with you, or that is that's sort of extraordinary. And what are you going to do about that lender to either satisfy the contract, or to kind of give me a chance of satisfying my end of the contract? Right? Like that's usually the two reasons people sort of contact their banks or lenders, that I was expecting this, it hasn't happened yet, or
yes.
right, or look, I've got a problem, help me out a little bit, sort of thing. And those are very much the problems that we're seeking that we're seeking to address, and are a good way down the track.
Yeah,
doing,
cool.
some stuff out in the wild.
No, it kind of sounds good. I mean, yeah, reinvention or the continued iteration of the reinvention of credit, we should say, is obviously a hot topic right now. We've got about 8 minutes left, and there's been a host of questions. So I wanted to carry on down that track, but I'll come to the questions, and then if we've got time, I'll bring them up in a sec. Simon Schofield, thanks for this question. He said, are there any barriers to entry that give the established vendors a stronghold in the marketplace? So we're sort of going back to the conversation we were just having around, I guess, macro trends and the differentiations between yourselves and the incumbents.
Yeah, sure. I mean, fundamentally, right? It's like, and this is one man's opinion, so
it's all good. That's why you're here.
That's, I guess, that's why I'm here. But fundamentally, I think a lot of it comes down to the fact that the core banking market and the general sort of financial infrastructure market is a slow-moving market, right? Like, even if you're in a sales cycle, it takes months, if not years, sometimes, to actually go all the way from you had that initial meeting to you're doing your first you're doing your first account, your first payment, your first trade, whatever it is, and then you're sort of locked into a 10-year contract, 5-year contract, 15-year contract, something like that. So I think that fundamentally that is the barrier for any new entrant, right? So you have to be mindful of that as you're coming in, that actually you're potentially not going to find your 2 or 3 really big clients for a number of years, but that does also give you a number of years to build a really, really great product, right? Be it a payments product, be it a core product, be it a UX product, or whichever sort of part of the supply chain you're in. But when that opportunity does arrive, you've essentially got to sort of grab it by the scruff of the neck, because if you believe you've got the best product, and many companies in many ways do have the best product, and there's really, really healthy competition at the moment, then yeah, I think it'll actually yield better results for buyers on the other side.
Yeah, to be successful. Yeah, to be successful, you need to know the procurement times of banks. It's quite a weird phenomena, but it does work. Sahib Bakari, I'm hoping I said that right. He's asked, for completely personalized financial services, is it exclusively a tech play, or actually in the future will you also require old world services like branches and call centers? So I guess let's translate that to the use case that we've got. In what you're building, do you need? I'm not sure. I mean, at the moment, you've sort of got credit as the predominant use case. But let's say you were to go into, let's say, more sort of a general account management and things like that, account provision. Would you build for branches for call centers, or are you looking to democratize that completely?
I mean, we do offer deposits through the platform, right? And that's kind of an online deposits product, in the way that, particularly the way that the Chetwood use and the way Chetwood is set up, a brutally digital bank, in their words, not mine. But I think that it sort of doesn't matter, from our standpoint, because ultimately we provide a app that an agent can use that can be run in a branch just as well as it can be run, sort of in a call center. I mean, even sort of using the example of Chetwood again, like, they do have something that resembles a call center, because you have to have frontline staff who speak to end customers when there's a query, when there's when you have to sort of contact the customer for various reasons, etc. And that it does work in that way. But in terms of the question around sort of completely personalized financial services, I think you have to be mindful of the fact that it's sort of what I was saying earlier, that you have segments of customers or you have lots of segments of customers that are very, very different, and there's in terms of geography, age, business versus personal versus joint accounts versus guarantor structures, power of attorney structures, all these sorts of things, and not everything can be done online, or certainly not everything can be done effectively online as yet. So it's you do have to sort of be mindful of that. And equally, you have to be mindful of the experience that your that the client in the middle, the bank or the lender, is trying to offer to their customers, because they're going to understand their customers better than you do, right? As vendors, you have to be able to sort of build that flexibility in, and it's not, if you can do it so that if you built in a way that someone can log in to a web browser online, you're actually not that far away from doing any of the rest of it, because ultimately all applications have pretty much access to modern browsers now. So it's that. I mean, I think for completely personalized services in that sense, it's much more about being able to sort of bolt things together in a way that's actually priceable, right? You can get current accounts now that have got insurance products linked. I mean, for years you've been able to do that. They've got insurance products linked to them, and they've got cinema ticket discounts linked to them and stuff like that, which is great. Not hugely relevant to lots of people who end up with those products. So being able to sort of strip things out and put them back in and get sort of transparent breakdown of pricing and understand what you're paying for, what you're not, what you're getting, get nuggets around what you're using and not. I think that's kind of that's probably more where it's at.
That's a really interesting point in terms of how easy is it, first of all, for the customer to understand what they're paying for, but then also how easy is it for the provider to be able to price and break down the price and put together a package. I'm not going to say bundle because that's unregulated, but a package that I don't know, that's probably taboo as well. There you go. We should go into marketing. One last question, because we're coming to the top of the hour. Just more generalistic about Yobota. I suppose what's your vision for the future of the platform? So, and where do you say? I mean, I'm not talking 20 years, but if we're going to go 18 months, 2 years out, where do you see yourselves growing?
Yeah, I mean, our focus right now is kind of growing our client base. We've had a lot of good success over the last few years. And really, that's sort of everything we're doing right now is about either being able to make sure is making sure that we can serve our existing clients in a very effective way, and make sure they are getting everything that they need, and then that getting to a position where we are sort of doubling that sort of doubling the client base essentially every few months, every couple of quarters kind of thing, and that's sort of where it is, because once you can do that at speed, then you've actually got you've got a product that works, and the mission of what you're trying to achieve, which for us is making financial services intelligent, flexible, and about the customer, is something that you're well on the way of achieving, and that's kind of what we are what we're making sure all of our resources are pointing at.
Cool. Ammar, thank you so much for coming on. It's much appreciated. We go way back.
Thank you.
So it's been a pleasure to see you on here, and thanks very much for taking the time. For everybody else, I'm sure you guys have got days to get to. Where can people very quickly find out more about yourself and Yobota?
Yeah, I mean, you can find me on LinkedIn. Yobota we're on Yobota.com, or you can find us on Twitter at Yobota Platform. Or just drop an email to hello@yobota.xyz.
Wicked. Thanks so much. That's all we have for this week. On Monday, Mr. Moore will be back with Maria Schuld from FIS at 3:30 p.m. BST. Have a great weekend, everybody, and goodbye. And